Do you have a plan that insulates you from your emotion?
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
Brace yourselves. What just happened on August 5th, 2024 might be the beginning of a financial storm like never seen. From Tokyo to Wall Street, markets are in free fall and recession fears are skyrocketing. Stay tuned to find out what triggered this global sell-off and how you can protect your investment in turbulent times. Are you freaking sick and tired of these sensational headlines? I mean, is it noise? Do we know why? Do we really know why the market sold off? Is one stock in the stock market up exponentially higher than anything we've seen in a long, long time jump for artificial intelligence purposes? Did the CEO of that company just sell a tremendous amount of stock prior to the correction? Is that insider trading? Is that knowledge? No, it's just normal part of a process, okay, of protecting and growing wealth. Market volatility is something that is a normal situation. For as long as I've been on the planet, which is 56 years and counting, market volatility has been here. We have history that goes back and shows market volatility way back, all right? In my wealth curve, I have stuff back to 1928, 1929. Big popular American funds, investment company of America has a track record, I think back to 1927. Like, you can see the volatility of these charts. My goal in today's conversation is to eliminate the noise, okay? And noise is what takes people out of their game. And when you get taken out of your game for things that don't necessarily make sense in the big picture, you stop your financial plan. And when you stop your financial plan, that's when people get into trouble. Dot-com bubble burst. 2000, 2002, NASDAQ fell 78%, peak to trough. S&P dropped 50%. Global financial crisis, 07, 09. S&P lost another 57%. European debt crisis, S&P dropped 19%. Chinese stock market, turmoil of 2015-16. S&P dropped 12%. COVID-19, the markets plunged 34%. In October of 23, NASDAQ fell nearly 12% since mid-July, influenced by declining consumer sentiment and disappointing earnings. Right now, we're having disappointing earnings. What happens, and I can talk about this for a second from the standpoint of how many people stop saving when prices are down. And depending on where your favorite store is, right? Think about this for a second. Do you have a favorite place that you like to shop? And there are things that are in that store that are high price that you don't necessarily buy today. But when it's having a sale, like a Black Friday sale, people line up around the block to buy things at a discounted price. But the very thing that we should be buying at a discounted price, our psyche and our thinking stops us from doing exactly what we do when we buy material items. And I question the sanity of this. So I go back to the quote, right? Everything we hear is an opinion. So all the headlines of the reason why, there's a lot of factual information in that data. But the opinion formed by that is formed by a cluster of beliefs over the many, many years of how I perceive this market downturn to be. Look at the charts. These are downloaded this morning from JP Morgan Guide to Markets, a very reliable source of information, okay? And what's interesting is this chart that I'm looking at is gauging the consumer sentiment. How do people feel about the economy? And what I want you to look at is, it's a very busy chart with lots of numbers and averages and et cetera. But above the line is strong sentiment. People are bullish. People feel really good. Below the line, people are concerned. What's going on with the black line in this chart? The black line is the actual direction of the market during that time frame. So when markets are high, people feel good. When markets are low, people feel bad. And then the news perpetuates this feeling, and I jump onto the news, and the news now makes me feel bad. Instead of looking at this as an opportunity to buy things at a discounted price, I retreat. Somebody else sells something, and now that triggers, oh, maybe I should be selling, because I don't want to be the last man standing. And that in itself is what creates these issues in the long-term plan. During the global pandemic, the amount of people that stopped 401k contributions, giving up the match and not taking advantage of the down market was a huge percentage. I don't have the exact stats, but it was a very big percentage of people who stopped doing this, right? So when you play by a rule book, as opposed to playing by emotions, and you have a set of principles that are guiding your long-term financial plan, the market volatility is something that I look at as curiosity, something that I look at as a regular phenomenon, something that's going to happen on a daily basis, right? And when it happens on a daily basis, then that becomes normal. So there's a couple things that I want to focus on. This happens to be one of my favorite charts. This chart is pulling 48 years of market data. 48 freaking years of market data. And I want you to look at this. Actually, let's go to the S&P one. It's 44 years of freaking market data, not the aggregate, all right? So 44 years of data. If you're born in 1980, you are 44 years old. For your entire lifetime, if you're listening to this podcast, your entire lifetime, this has been true. So when you look at this chart, you see S&P intra-year declines versus calendar year returns. The black line says 1980, the market was up 26%. It ended the year 26% up. Somewhere in the middle of that year, I'm not exactly sure, the chart doesn't tell me what point in time it was, but the market was down 17%. Now the question is, did you buy when the market was down 17%? So in my book, It's Your Wealth, Keep It, I have a chart, I have a chapter, not a chart, but a chapter where I talk about sequence of returns, average versus actual return. And nobody gets the 26% return unless I put $1 in at the beginning of the year and I sat there to the end of the year. Now, how many people are actually investing or withdrawing during the time frame? So if I withdraw money during that time frame, when did I withdraw that money? Did I withdraw it when the market was down 17%? And I went for fear, I just locked in a gain. A loss. I just locked in a loss, right? If I'm dollar cost averaging in, I got a different rate of return than the 26% because I was buying at different inflection points during the course of that year. If I waited and had the magic crystal ball and said, 17% is it, it's not going any lower, and I dive in, I have much greater than a 26% return. If I'm systematically withdrawing money because I'm retired, I have a different rate of return than 26% because I was pulling shares out when the market was down 17%. I just increased the probability of running out of freaking money in retirement. But I want you to dig deeper into this chart and look at this and say, every single year, there is a red inflection point in the year. 33 of 44 years had a positive return. That means 11 years were negative. 11 out of 44. It's like 20-something%. So 75% of the time, the markets are positive. But in the distant future, prices will be higher in the securities that I'm buying. Now, we can argue single stock concentration. We can go all through these different things. The reality is the stocks get a market return. Some stocks are outliers for a long time, but typically they come back to the norm. There's some fabulous pieces out here that we can document that I'm not going to go through today that say, what's the difference in the rate of return when somebody buys at the very lowest versus the very highest day of the year? And it's not that different in the long run. You're still going to have a successful plan, even if you were the loser buying on the worst day, okay? If you didn't deviate from that. Now, mentally in your brain, how do I defend against my own internal demons of wanting to cash in and get out of the market and not take advantage of this down market? I got to have a certain amount of cash relative to my plan and my goals and with stuff that I want to accomplish. I've got to have defensive assets. I've got to have bonds. I've got to have life insurance cash values. I've got to have money for short-term immediate goals that are coming up in 4 to 5 years, which can have a different investment philosophy. If I have rental properties, I've got to have reserves that are backing that up in case I lose a tenant or have a big, flood that's underinsured, right? There's things that I got to be thinking about in my plan, and I need structure in that plan. But part of my plan is I'm going to take a systematic amount of money out of my cash flow, out of my earned income, and invest it in assets that are going to be stock driven, that are by nature are going to have a significant amount of volatility. This is from 1996. This is the market peak to trough since 1996. So when I started in the business, it was 1989, 1990, full-time, came out of college, Bentley College at the time, now Bentley University. So I got upgraded with my degree. I'm very excited about that. Okay. Interest rates were super high, and nobody wanted to invest in the stock market because they were still hung over from 1987. And they're like, bonds have a super high rate of return. Why wouldn't I just buy bonds? And I was forcing people to get to 10% allocation, to 20% allocation in equities. And then the market had a 1995, 1996, we had a 35% uptick in the market. People were like, oh, the internet thing, this thing's going to be big. And then I'm sitting on the soccer field with young kids. And if people are now day trading. If you can't get me a 27% rate of return, we're not going to work with you, John. And I'm like, that's not going to happen for a long time. We had 100% run up from 1996 to March 24th of 2000. And then we had a 49% downturn into the valley of whatever that is, 2002, October 9th of 2002. How many people ran for the hills? Now, people invested in things that were super high risky and they did lose money. But if you were in a diversified strategy, you had pain, but you didn't get decimated, right? And then nobody wanted to be in. And then the market went up 100%. And then people were like, I got to get in. And then we had this thing called the financial crisis, and the banks were defaulting, and Lehman Brothers went bankrupt, and Bear Stearns went down, and a whole bunch of other stuff. And then Glenn Beck had this wonderful hockey stick analogy that the government debt was going like a hockey stick. Visualize a hockey stick for a second, right? And the hockey stick was going to we were going to be dead as a country. And markets are down 50%. It's March. And people are like, you got to get me out. You're down 4.5% to 8% based on certain strategies. And the market's down 50%. We should be getting rid of all the hedging strategies, all of the things that, all your defense, all your cash values, just borrow cash, put it all into the market, and you want to go to cash at this point. Your psychology, because of the shit that I'm listening to, the noise that I'm listening to, is taking me out of my game. Don't let stuff take you out of your game. Okay, so when you ride this thing through, you then had this thing where quantitative easing, market runs up 400%. But you had a period in here in 2014 when the market quantitative easing ended. And nobody, the markets were sideways, up and down and quarter by quarter, like, hey, you're up and down. But it was literally a 24-month period. And then you had something called the Trump bump. And the market went up again. And then you had that 2020, 34% downturn, which I believe was the pandemic, right? What an opportunity. Then the market ran up 114%. And then we had the 2002. Remember the Christmas massacre? Remember that? There was a thing called the Christmas massacre. We had a 1,000-point day, like Christmas freaking Eve, right? Christmas Eve. We had 1,000, and then day after Christmas, it was back up. And then up here in 2024, market's up another 54% from that whole of 2022. But you had periods in October where it was down dramatically. You had periods in April, and you have periods of this. Situation normal. But it's it's the ride that gets you there. Average versus actual. If I have a sequence of returns that my money goes up 100% and then falls by 50%, my money went from 100,000, let's say, invested up to 200,000, and then the 200,000 falls 50%, I'm back down to 100,000. But that average would be 100 up minus 50. 100 minus 50 is 25. So the expectation in your spreadsheet is that I got 25% rate of return. So my 100 would go from 100 to 125 in my spreadsheet to 156,000, which is flawed thinking because people don't get average rates of return. People get actual rates of return. They get volatility adjusted returns based upon the flow in which they invest and how they take money out. And when you're building a long-term financial strategy, when you see the headlines of people who sold stock, people who did things. I mean, Mr. Buffett came out on, I believe it was Friday, and sold half of his Apple stake. I thought that, when I saw that headline, it was going to trigger a sell-off that. But there was other reasons out there, right, that caused things to drop. That noise got lost because there was other things. So here's what I want you to do is, do you have a plan that insulates you from your emotions? Because the emotions are what destroy the plan, not the plan itself. This was awesome. Like it, share us, hate us, comment us. By the way, I'm wearing my most recent new shirt, Money Isn't. Like some feedback. Do you like them? And would you want one? That's what I want to know so I can order the right amount. Thanks.